Let's get some more views on this too now. And joining us live from the CME Group in Chicago is Larry Shover, Chief Investment Officer at SFG Alternatives. Larry, what do you think? We were hearing from Wall Street Journal's John Hilsenrath that the underutilisation in the workplace, that is still a key worry for the Fed. And Paul Bloxham, HSBC, also just saying that too, the last report that we had from US non-farm payrolls wasn't great. What's your view on what the Fed might do tomorrow?
I think it's going to be underwhelming and a disappointment. I mean, the odds are with me is that she will, in fact, drop the considerable time sentence in the conference. To me, also, it's immaterial. When it comes to a grand exit strategy, I don't see it. I see more of a rerun that we've already seen maybe in June or July. I do think, though, that, or I still think that we'll see our first rate hike in June of next year. I've kind of leaned that way the past 6 months or so. But I do think because of the run-up we saw today, it's just going to underwhelm the market on a short-term basis because I don't think anything big is going to happen.
And I mean, so you think how do markets react to that then? You say it'll be a disappointment. So how do you see, I mean, markets have rallied today, or equity markets, into this outcome. What do you think?
Well, first of all, I think the markets rallied today for a variety of reasons. But one is that positioning has been super gloomy the past 3 to 5 trading days. We haven't done a thing since August 25th, really. And you have the PBOC coming out, adding liquidity to 5 of the biggest banks to the tune of 500 billion won. That means something. And yeah, obviously, when John Hilsenrath speaks the way he did, that's going to get people's attention. But I think a lot of it is positioning, and the market was just ripe for a snapback rally today.
Just on, the other things, as you mentioned, that markets are watching. We've had some pretty dire warnings from the OECD coming through, and particularly worries about the Eurozone too. Obviously, there's a lot of uncertainty leading up to the Scottish independence vote. Just watching sterling lifting against the greenback, a new poll showing Scottish support for staying with the UK now at 52%. That obviously still a big focus for markets.
Yeah, I think it is. I mean, especially Thursday. There's so much glamour and headline talk about any type of asset purchases by the ECB. But really, on an institutional level, we need to be focusing more on their long-term financing and the results of that. What will the buy-in be? To me, I'm looking at about 125 to 150 billion euro. Anything north of that would be a huge success. And really, if we want to see this succeed, we want to see the LTROs do well because they're accepted on an institutional level. I still can't figure out how they're going to pull off any type of asset purchase, no matter how sexy it appears.
So I guess in terms of what you do then, I mean, are you looking at opportunities in Europe given the moves lower that we have seen?
Yeah, I definitely am. I mean, I still believe the U.S. dollar is going to remain strong through the end of the year. I say that very slowly and carefully because it's taken a long time for me to be correct on this call, and I think it's a very, very crowded trade. So if you're wrong, you're going to be really wrong. I do think there's some pockets of value, some big pockets of value in the European equity markets, and I would, instead of picking out sectors, I would just go broad-based because on a multiple level, much lower than the U.S., and they will get out of this slump that they're in right now. Beyond that, one thing I'm seeing, I still continue to see some divergence in the commodities markets. You had mentioned iron ore. We see like Tokyo rubber at a 5-year low. Steel rebar is at a 1-year low. I do think it might be time to start bottom fishing in some of these current commodities.